Hello to you, new, aspiring, or established investor. So in this course, I'm going to talk about expenses, pensions, and insurance. Now, to begin, please note that the greatest law of wealth is sowing and reaping. Essentially, you get whatever you put in, and there are really four investment inputs. You have capital, risk, time, and skill. Capital is your disposable income. So contrary to what some people may think, you cannot invest your way out of poverty. Investment assumes you have some disposable income that you can set aside over a long period of time. So you cannot be an effective investor unless you have some capital at your disposal. And typically, to increase your capital, you either have to reduce your cost or improve your income earning potential. It may be through a higher paying job, a business, a side hustle, whatever it is. That's how you set aside disposable income for investment. The second item is risk, and that's because risk is typically proportional to reward. So the lower risk investment classes typically have the lowest returns on investments, while the higher risk investment classes typically have a higher potential return on investment, with the caveat that you may lose some or all of the capital. So typically the rule of thumb is you take more risk when you're young and you can bounce back. You also take more risks when you have more disposable income, such that even if you lose a percentage of that income, you're still okay. Another rule of thumb is to diversify and not put all your eggs in one investment basket. So if you lose, one basket, the other basket is still available. The third input is time. Because of the principle of compounding, if you start when you're young, over a period of 5, 10, 20 years, because you're rolling over that investment from year to year, you're benefiting from compound return. Time also has a second side to it, and that's how much time you have to invest. So if you're a busy professional or a busy entrepreneur, chances are you may not have as much time to invest on your own, and you might need to depend on a licensed investment advisor for help. And then finally, skill. Do you have the financial literacy? Are you knowledgeable? Have you learned or trained yourself to invest, in different asset classes? So some people decide on their own they're going to learn how to invest in stocks, or they're going to learn how to invest in real estate. That's a level of skill. So sometimes, depending on if you have the time to invest yourself, you can decide to learn those investing skills based on the asset class of your interest. But these are the four inputs. So what you put in terms of capital, risk, time, and skill is exactly what you're going to get out. There's no magic to it. Now, there are three ways you can meet your day-to-day expenses. You can do that through a salary, you can do that through a pension if you're retired, and then finally you can live off the return on your investment. Obviously, that's why we're all watching this course, because we want to find a way to live off the return on our investment. If we decide we're not going to work again, are our investments sufficient to take care of our day-to-day expenses? Can we literally retire off of our investments? That's really part of the purpose of this course. If you decide you're going to use in your return on investment to meet your expenses, then there are two strategies you can employ. One is called target investing, and the second one is called income investing. For target investing, I've done a video using the compound interest toolkit. So this is a screenshot from the compound interest toolkit, and there's a video that you can watch on how to use it. So let's look at this hypothetical scenario. You want to invest an average of $62,000 every year. So if you divide that by 12, that's about $5,000 per month. So this is a typical target investing. I want to invest $5,000 every month at an annual interest of 12%, which is the performance of the S&P 500 over the last 10 years, 2022 to 2012 to 2022. So let's just use that as a pretty medium risk, no effort way of investing, and you get your 10 to 12% year on year, but over a very long period of time. Now, if your target is to achieve a nest egg of $5 million, it's going to take you 20 years to achieve that. So that's why I said the variables are time, risk, capital, and skill. So this investment presumes you have capital of $5,000 every month, or $62,000 over a year. It assumes medium risk, because this is a passive investment. All you're doing is buying ETFs, a range of ETFs that track, say, the S&P 500, the top 500 stocks on the US stock exchange. So you're not doing anything beyond setting up an auto debit, and every month you buy the same set of ETFs. So it doesn't require a lot of skill. It doesn't require a lot of time. So that's the two variables, time and risk. So let's assume this is the plan. It's going to take you 20 years. So it's going to take a lot of time, a lot of compounding. So this plan is suitable for someone who starts young. So if you start when you're young, by the time you're retiring, you will have, this nest egg. So please open the compound interest toolkit, run the numbers. You can put different variables, the amount of capital, the amount of time. Just change the variables around until you get a plan that seems feasible for your present and future circumstances. The other type of investment is what I call an investment cascade. Now, this is a beautiful plan for those who want to earn a monthly income. So this plan assumes that you invest $10,000 every month for 12 months. And it also assumes a 20% return on investment. So this is just a placeholder. It could be 12%, it could be 10%, but let's assume you're lucky and you happen to find an investment that gives you 20% return in 12 months. Now, how this plan works is that every month you put down the same amount, say $10,000, or you can convert that to your local currency as well. Now, if you do that consistently for 12 months, at the end of 1 year, so by the time you're going into year 2, in January, because it's a 20% return in 12 months, that capital would have gained $2,000 and you'll be getting $12,000. Now, what you do is you can spend the $2,000 on top and then reinvest the $10,000. So what it means is your investment goes on autopilot every single month going forward. After you've done this every month for 12 months, you get that $2,000 which you can spend, and then you can automatically roll over the $10,000. So this is a good plan for those who want a retirement plan or an income plan that runs on autopilot. And it's something that your financial advisor, your licensed financial advisor, can create for you, such that once you've done this for 1 year or 2 years or 3 years, thereafter you're just living off the income and rolling over the capital from month to month. So this is a good way to just get some income into your bank account every single month while just running an autopilot investment. And I call this the investment cascade model. Now, don't be one crisis away from poverty, and this is where insurance comes in. As much as possible, you need insurance that takes care of your significant out-of-pocket expenses should anything go wrong. And we'll talk about this. Now, try and invest as much as you can in your tax-free pension. Most pension plans are tax-free. So it does make sense to max out whatever allowance you have. It could be your Roth IRA, it could be your 401k, it could be your state government run pension plan, whatever it is. Max it out because it's tax-free. You're just putting aside income every month. If you have a job or you're an entrepreneur or you have a company sponsored pension plan, it's just income you're setting aside, and at the end of your working life, you have that income tax-free, which you can then use, for whatever it is you want to do. Go on a holiday, buy more, real estate, but it's just a good way to reduce, because if you don't invest that money, you're going to get taxed on it anyway. So you might as well just put it in a tax-free pension fund that you can have after 15, 20 years. So max out whatever pension plan that you have, knowing that it's almost like the best of two evils. It's better not to give that money to Uncle Sam as tax and just put it aside, even if you can't use it until a decade or more, but you can max it out. Another thing you should do is use insurance to avoid significant out-of-pocket expenses. So things like health, your home should be insured, your car should be insured. Anything that costs a lot and you feel that it's better to just pay the insurance premium now. Yes, you may not eventually use it, but insurance is just one of those what if types of plans where you pay for it, you hope never to use it, but just in case you need to use it, the insurance is there and you're not paying out of pocket. There's some people that go bankrupt because of healthcare expenses. They go bankrupt because maybe there's a fire, they lose their home and they can't rebuild. So use insurance to avoid any significant out-of-pocket emergencies. It's just a good thing to do, especially because of health. Some people say there are only two things that are sure, taxes and death. So at some point in your life, certain parts of your body will break down. You will need to seek health care at some point in your life. So it's always best to just have the insurance to take care of that. So it's not even something you worry about for yourself and your family. Some people use a universal life insurance plan as a way of becoming their own bank. So a universal life insurance plan is really just an insurance plan that is invested for you. Typically it tracks the S&P 500. Some other insurance plans track other things, but the good thing about it is that you can borrow against it tax-free. So let's assume you have this insurance plan running and you want to maybe buy another asset like real estate. Instead of going to a bank and paying a premium to borrow that money from a bank, you can borrow against your universal life insurance plan at no premium and it's tax-free. So it's one of the ways people become more tax efficient, and there's this whole craze around becoming your own bank. So you can research that and talk to a licensed investment professional or a licensed insurance professional about how you can create a universal life insurance plan and become your own bank. So such that in future, when you want to buy other assets, you don't necessarily need to go to a bank to get that money. You can just borrow against the money you set aside over several years. So it's a good way to use debt or leverage. The rule of thumb is to get health insurance when you're young, and that's because your premiums are typically cheaper before you start having a lot of the age-related diseases that kind of come over time. So sometimes when you try to get premium insurance when you already have pre-existing conditions, your premium will be expensive. But if you get your health insurance when you're young and you just keep renewing year after year, some of those extra expenses will be waived because you're a long-term customer. So sometimes get your health insurance when you're young. It could be as part of your job or part of it could be a business expense as well, such that as you grow older, you don't have to pay a significant markup or a significant premium to cover pre-existing conditions, if you get it when you're much older and you already have those conditions. Finally, life insurance can become seed capital for your children. So there are a number of life insurance plans where if you don't claim it over a period, for some plans it's 20 years, you can cash out that insurance plan, and it's something you can just pass on to your children. You can use it to help them set up a business, go to college, and all of that. So it's not all life insurance plans that vest when you die. There are some life insurance plans that depending on the type of plan, if you don't use it for a period of time, you can actually cash it even in your lifetime. So these are the reason why I've put all of these in this course, is it helps you to ask intelligent questions. When you sit across your licensed investment professional, you can use this as a checklist, and you can just ask them, oh, have I invested as much as I can in my pension? Tell me about a universal life insurance plan. When you're talking to your insurance company, ask about, oh, do you have a life insurance plan that vests maybe in 20 years, even when I'm alive? So this is a good checklist for you to take along with you when you have a conversation with your licensed investment professional. So finally, these are 2 assignments. Run projections using the compound interest toolkit. Estimate what you need to do now to attain financial freedom in future. So play around with initial capital, time, return on investment. If you want to target investment, work your way from the end. Put the target, put how many years you have, and then see how much you need to invest every year to attain that target. And then research health and life insurance plans. Talk to a licensed insurance agent about the different plans that are available to you. Thank you, and I'll see you in the next video.